Okay, here's our game plan for today to help you lock in those top marks. We are looking at 1. Final balances, 2. Section 37 options, 3. JLP entries, 4. Mid-year profits, and finally, 5. Exam review.
Let's kick things off with Section 1, Reconstitution and Final Balances. Now, we really need to clarify a fundamental concept that examiners absolutely love to test. When a partner dies, the business of the partnership firm doesn't necessarily just end, it's not over. Instead, it triggers what we call a reconstitution of partnership. Basically, the surviving partners keep running the business. But kind of like in a retirement scenario, the firm's assets and liabilities have to be revalued. Think of the partnership like a giant pie. The pie itself doesn't disappear, it just gets resliced among the continuing partners.
So what exactly is the deceased partner's estate entitled to? Well, mentally tick these off when you're sitting in the exam hall. The legal representatives are owed the capital account balance, any interest on capital that was provided in the deed up to the date of death, their share of goodwill, a share of undistributed profits or reserves, the profits on the revaluation of assets, their share of profit up to the date of death, and finally, their share of the joint life policy. If you systematically hunt for each of these 7 items in an exam question, you literally won't miss a thing.
Moving right along to Section 2, Section 37 options, which I like to call the big choice.
This next area is a massive exam trap. It catches so many students off guard. We're talking about Section 37 of the Indian Partnership Act. You see, what happens if the surviving partners just keep running the business without actually settling the final accounts with the deceased partner's estate? Well, if there isn't a specific contract stating otherwise, Section 37 automatically kicks in to protect the outgoing partner's representatives. Because think about it, their money is still sitting right there in the firm being used to generate revenue. So they are entitled to compensation. And the law actually gives them a choice in how they receive it.
The executor of the estate gets 2 options. Option A. They can choose to take a share of the subsequent profits made since the partner died, specifically the portion tied to the use of their share of the firm's property. Or, option B, they can choose a fixed interest rate on the amount of their share in the property. And here's the really cool part. They aren't forced to choose right away. They can actually wait until the profit share is figured out to see which option puts more money in their pocket.
Now, the absolutely crucial point here is this exact number, 6%. If they go with the fixed interest route under option B, the statutory rate is 6% per annum. If your exam question throws a delayed settlement at you and doesn't explicitly specify a different contracted rate, 6% is the exact number you have to use to calculate their interest. Seriously, burn that number into your brain.
All right, on to Section 3, Joint Life Policy or JLP entries.
While the accounting treatment here feels a lot like retirement, there is one major difference when a death occurs. Unlike retirement, where you might only get a surrender value, upon death, the firm gets the full joint policy sum assured from the insurance company. It's a bigger payout. Let's walk through the chronological journal entries. Step 1, the firm gets the cash. You debit the bank account, and you credit the joint life policy account with that full policy value received. Step 2, you distribute it. You debit the JLP account to write it off, and you credit all partners' capital accounts. Remember, this goes to all partners, yes, including the deceased partner, and it's divided up using their old profit-sharing ratio.
Oh, and please, whatever you do, don't forget this crucial 3rd step. If the exam problem states that a joint life policy reserve method was being used by the firm, you absolutely must close that reserve account. You do this by debiting the joint life policy reserve account and crediting the partner's capital accounts, again, using that old profit-sharing ratio. It is such an easy mark to grab, but so easy to overlook when you're stressed out on test day.
Next up, Section 4, Apportioning Mid-Year Profits.
When a partner dies right in the middle of the financial year, calculating their exact share of profits for that random fraction of a year is usually the trickiest math on the whole paper. Let's walk through the exact formula using a great example straight from the source material. Imagine partners sharing profits in a 2:1 ratio. A partner dies on April 15th and the books close on December 31st. So the executor is entitled to exactly 3.5 months of profit. If we use the previous year's profit of 96,000 rupees as our base, first we time apportion it. 96,000 multiplied by 3.5 over 12 gives us 28,000 rupees for the firm's total profit during that specific window. Finally, we multiply that by the deceased partner's specific profit-sharing ratio, in this case, 2/5. That gives us 11,200 rupees. Just remember this structured 3-step process: base, time, share.
Okay, so you've done the math. You know the amount is 11,200.
But here is a question to test your accounting reflexes. How do we actually record this profit in the firm's books when the partner dies mid-year? Because, this is happening long before the final profit and loss account is actually drawn up in December.
Enter your golden key, the profit and loss suspense account. You debit the profit and loss suspense account, and you credit the deceased partner's capital account. Basically, this suspense account acts as a temporary parking spot for these funds. Later on, when the actual year-end finally rolls around, the suspense account balance is simply transferred right over to the regular profit and loss account. Makes sense, right?
Let's wrap things up with Section 5, Exam Day Final Review.
Let's consolidate everything we've learned and highlight a few common pitfalls so you don't leak any precious marks. I want to point out one more massive exam trap based on the practical journal entry questions we've seen. Now, we all remember to share out revaluation profits, but if assets decrease in value and there's a revaluation loss, students sometimes freeze up. They hesitate. Just remember this golden rule. Revaluation profit or loss goes to all partners, absolutely including the deceased partner's estate, in their old profit-sharing ratio. The logic here is simple. The change in that asset's value happened while they were still alive and still a part of the firm.
We've covered the crucial checklist, that tricky 6% statutory interest rate under Section 37, the full value JLP entries, and the exact mechanics of the P&L suspense account. So my final question to you is, are you ready to master these partnership rules under exam pressure? Because I really think you are. Review this explainer one more time before test day, keep these concepts fresh in your mind, and you will absolutely crush it. Keep studying hard, and I'll see you next time.